Hi, this is Doug Howard, president of Growth Team Strategies, here with another episode of Selling the Dream, our podcast about things people should be thinking about when they're in the process of either selling their business or even just thinking about wanting to have a business that they can sell or transition at some point. I'm joined today with my delightful co-host from Texas, Kathi Fleck, one of our consultants, one of our former clients, and a true success story in going through the selling the dream process. How are you today, Kathi?
I'm great, Doug. How are you doing?
You're great every day. You're
I
in
know I am.
Texas. You're living the dream. I mean, we're selling the dream. You're living the dream, right? So,
Somebody has to.
that's exactly right. And it sure as hell ain't me. But anyhow, that's neither here nor there. All right. And today we're also joined, we're super excited about today having a guest, Jim Laird. He's the owner, president of Laird Valuations. Really specializes in business valuation. We've had the opportunity to work together on some projects. He's going to share with us a little bit about the process and his approach and that kind of thing. Jim, welcome. Thanks for being here today.
Thank you, Doug. It's good to be
Yeah.
here.
Yeah. So, and Jim is in Michigan. So we're covering a good bit of the United States.
Mm-hmm.
You know, if we added Florida and Ohio, I could probably run for president or something. But we'll leave that for another day, right? We want to
All
we
right.
want to stay non-controversial in every way possible. So Jim, tell us a little bit about sort of your business and how you came to be in this business, and what the whole valuation process looks like, and we'll have some questions for you as well. And of course, Kathy's been through that process too.
Well, I started out as a CPA in practice after college, and was an auditor and performed some tax work as well. But most of it was in the audit field. And when I went corporate, I began doing valuation for acquisitions. Usually, many companies like to expand by virtue of acquisition, in addition to organic expansion. And that is where I got started with the valuation process, albeit from a very targeted standpoint, a very strategic standpoint.
Mm-hmm.
Um, Eventually, I managed to go out on my own and practice for a couple of years, actually, just in medical practices, medical fair market compensation, dentistry, eye doctors, like that. And that led me to, I was approached to do other types of work as well because I had a history in it, which is to
Uh-huh.
say corporate, manufacturing specifically, construction, other types of distribution and warehousing, a variety of other types of small businesses to medium-sized businesses. And since I've been on my own, the largest company I've worked on is over 100 million, and the smallest is about under 500,000. And so I have quite a broad spread there, if you want to call it. The sweet spot for me is right around between 25 and $50 million, but frankly, I can go either side of that without any problem, adapt to the need of the
Yep.
client, depending on what they're facing. In terms of the construction industry, I've done quite a number of construction, both general contractors as well as subcontractors, the electricians, the plumbers, the HVAC, like that. And so I've had a fairly strong exposure to that arena. And it's something that I'm finding is both fascinating and has its challenges as well. It's an interesting business that they truly need to plan ahead, especially on
Yep.
the exit side. It's not as simple as some businesses like retail, where it's a very quick swap out. Construction is much more involved and a good deal more complicated in terms of the contract tie-up, or setup. So that's my general start into into helping people transition at the end, for any of a variety of reasons.
Your question.
Yeah. So let me ask you, Jim. So a lot of times I think people, when they think about evaluation, right, one of the things they're thinking about is, I want a valuation that's going to help me justify, right, a particular price, a particular value for my
Right,
company.
right.
So when you start with somebody, I mean, is that something that they share with you? Is it easier for you to start with kind of a blank slate? Like, how do you approach even that whole conversation, and why we're doing the valuation?
Well, first of all, that is where I start. Why are we doing it? The purpose of the
Okay.
valuation will dictate an awful lot about how I go about the process.
Okay.
And um, generally speaking, if it's a transition or a sale, then we're looking for a specific type of valuation, which is a fair market or a fair value, a market value, as though it were going to be sold. That gets more complicated if they're selling a fractional interest, but
Yeah.
we can save on that for a little while. For example, if they're selling their son or an employee or their daughter, some, 49% or less,
Yeah.
then a bunch of extra, adjustments have to come into play for that because of lack of control and lack of marketability. And so if we just say, okay, let's take the whole company and it's 100% transition, they're gonna sell it in one way or another, and they're gonna
Uh-huh.
do this in 3 to 5 years.
Yeah.
Then what we need to do is figure out, A, where do they stand today based on how the industry and buyers would be looking at them, how they are looked upon by the banking community, and it's very important that they be prepared for that,
Hmm.
how those entities are going to look at um, the valuation is different than um, than how they themselves might have been looking at it all these years that they've been working the company.
Right.
And
Right.
that conversation is part of what I have with them up front. In
Gotcha.
terms of their expectations, many owners have an idea that their company is always worth probably more than it really is, because when they step into the shoes of the buyer, it's like, what is the buyer willing to pay for this and why? And that's what I help them define as the why. Why is it worth this? It's worth this because the industry says the rates of return are this and your cash flow is this. And so value by default is that, is the consequence of that.
Gotcha.
And this is where uh, my valuation and your work, Doug, or your work, Kathi, would all start to kind of come together, especially if there's some lead time, 3 to 5 years, where they have a chance to realign some of the costs and how they're pushing them through their income statements,
Okay.
and or how they're structuring their capital, the balance sheet.
Yeah. Yeah. Yeah.
And
That
those
makes
things
sense.
can play a big role in that valuation.
Gotcha. Now, Kathi, when you sold your business, your initial valuation wasn't really anywhere near what you wanted for the business, right?
No, yeah, right. It wasn't. And so in 2017, I had a valuation done, and it wasn't where I wanted it. And I knew I wasn't ready to retire. So with the company that I worked with, I had about a 3 year time frame before I needed to have it revalued for
Mm-hmm.
an additional charge. And so in 2020, right before COVID hit, we revalued it and was ready to put it on the market. So I was fine with the valuation at that point, and I was really emotionally ready to sell. Of course, I had to ride through the COVID issue for a while too.
Right.
But yeah.
Yeah. Now, Kathi, when that came up, when you looked at that first valuation, were there clues from that first valuation that kind of helped you define what you wanted to do or change or improve before you got to that next valuation? You know what I mean? Was there sort of a roadmap or?
Well, I don't think I was given a roadmap, but I was already working with you and with remodeling organizations. So
Sure.
it's really to put the processes together, of course, increase the financials. I still had the roadblocks that I walked into even when I went to sell because I was the main person of the business. I wore a lot of hats, and with me gone, somebody else was going to have to pick up parts of different roles. So I knew I was going to have that, but it was just what it was.
Sure.
So
Yeah. Now, Jim, you also do some work with folks when they already have a successor in mind, right? Kind of gives a basis for, how the business should transition, right? I know one of the projects you worked on with some of our clients were folks that were family members. It was
Right.
transitioning. We knew who the buyer was, but they also needed kind of some rules of the road to kind of figure out how to transition there. So what is that like? Because that's a different kind of valuation, right? Or at least a
It
different
is.
approach.
It is. That type of valuation is what I was kind of alluding to a little bit ago, that
Yeah.
it matters whether it's a fractional interest or a whole business at one
Yeah.
time. And that makes if it's a fractional interest, which is to say they don't have control of the company, then that fractional interest is worth less than what it would be were simply a piece of the whole thing selling. I mean, ultimately, if the sale of the whole company happens, then they will get their proportionate share. Absolutely. But
Right.
if something's happening interim between that point and today, then that marketability for lack of control is a very different number, and
So that's
that needs
really
to be
interesting,
brought to
Jim,
bear.
because so like if I was going to sell my business for, let's say it valued at $1 million and, Kathi wanted to buy it and she was going to buy 40% of it or buy into it, right? You're
Hmm.
saying that if we're not over that 51% or 50% number, if you've got more of a minority interest, it's not necessarily worth 40% of that whole number,
Right.
right?
It's worth
Got it.
considerably less
Yeah.
than that.
Well, is there a certain percentage that you think it would be worth? Or is it 20 or 30% of that
Well,
on a
that
general?
it depends
See,
on.
now
There's a
she's
lot of
interested in
facts and
buying my business.
circumstances there.
Yeah.
Yes.
Okay.
Yeah, there's a lot of facts and circumstances, but generally speaking, somewhere between uh, what I would say 65 and 75% of what it might
Okay.
ordinarily be.
Okay. Hmm.
Interesting. Now, does
Yeah.
it help, Jim, if they've got sort of an option to go, further? Like sometimes we'll see folks that'll say, like, okay, someone's going to buy in for a third or 40%, but over the next few years they have the option to buy more or buy all of it or whatever. Does that help drive that if that's sort of in the buyer's
It
control?
does. It will help
Okay.
drive value up a little bit. It's again dependent on the rest of the story. None of these operate in a vacuum. All
Sure.
of these pieces kind of come together either sequentially or collectively and will play their role in the longer term valuation. Generally speaking, as an appraiser, I'm looking out a couple of years and saying,
Uh-huh.
what is it? We're leaning forward. We're saying, what is it worth in the future? We base that on the past in part,
Hmm.
but generally speaking, we're saying, what is it going to be worth tomorrow and why? And that's the question we answer, is the why and the what. And so if we have more pieces of the puzzle, like control was, for example, in your example, if
Yeah.
they buy 40% this year and 30% next year, the control has shifted from the prior owner to the new owner, and
Hmm.
that valuation is going to move accordingly too, both their old piece and their new piece. And
Gotcha.
so there are a few more moving parts with that one. Not that it's a bad idea; it's a good idea,
Yeah.
particularly from the seller standpoint.
Yeah, no, that's interesting. So when you look at it, and I know you said it's really kind of based on the past, right? The history. How much does it like? So one of the questions I love to ask folks when we're working with, I just had a consult this morning with someone that's thinking about selling their business in about 3 years. I love to ask people, I know you want to be out in 2 or 3 years, but if you had 10 more years of runway, right? If you were going to stay for another 10 years,
Mhm.
what are the things that you would do to grow the business that you're just not going to do because you don't have that much time left or that much runway?
Mhm.
And I find that there's some really interesting answers, to that question.
Mhm.
We'd add a second location. Well, actually, I have the rights to be in this part of the state. I'd add another crew. Whatever, right? So, how much does sort of a roadmap for how the business could grow, or what things are kind of forward looking that can have an impact on, how that value comes together?
Okay, from my standpoint and my experience, based on the financial statements I tend to see, the
Yep.
companies are small enough, or maybe you'd call it too small, to have diversifications in terms of geography.
Yep.
They don't usually shift out of their chosen professional designation. So if they're a
Okay.
tradesman of electricity, they stay there. Then the question becomes, how do they grow? They add crews based on their margins. It
Okay.
will become more valuable. What they want to do internally is keep their records cleaner. That I
Okay.
can't emphasize enough, is because having good, clean records and demonstrating clearly in their financial statements what they're making and taking out of the company for the owner is very helpful.
All right. No, I was going to say for a
Specifically,
lot of our folks, like, what do you mean by that? What does a clean set of financials look like as opposed to a
okay.
messy set of financials?
Number one, have knowledge of. Let's start with from the corporate standpoint. Have knowledge of the economy and when it's going to shift and what they should be doing proactively, preemptively, before they get hit with something.
Okay.
Now, in the construction, that's a little more of a lagger business. And so they've got a little more time than the average because their contracts run into, but then they get trouble getting started coming out on the other end. So
Hmm.
they want to know where they stand and plan accordingly.
Okay.
Second, they want to make sure that by clean, I mean they've identified rather than buried what they're taking out of the company. Okay, don't be taking things out of the company that aren't disclosed, such as trips, such as gas for the car, such as insurance for the car and the family, such as property taxes for your vacation residents going through the company. I get the idea where you want to save taxes. I get that. But particularly when you're facing a transition and a sale, you want them as clean as possible, and it to be just a few lines on that balance or on the income statement that says this is what I'm taking out of it. This is what
Yeah.
they're going for. Here you go.
Okay.
That tells a buyer a few things. Number one, that the books are clean. You're
Yeah.
just being honest, and that goes a long ways in value. That helps
Yeah.
immensely.
Yeah.
So
No, that makes
excellent.
sense. Okay,
I
Kathy, you had a
saw
question. Yeah.
I saw a situation where a seller wanted to sell his business for somewhere around, let's say, minimum of 3 million, and but his numbers did not show that that was going to work out. Then he
Okay.
started disclosing all this additional money that he was taking out that he could easily put back in, but it was kind of like you said, Jim, very messy books. And unless he was going to take some time, meaning a few years, to get his books cleaned up, he wasn't going to get the
Right.
value that he expected to for his business.
That's what happens. That's exactly what
Yeah.
Mm-hmm.
happens.
Okay. All right. So certainly clean up the books. One of the things we find too is once you're in the process, of selling,
Mm-hmm.
it doesn't take much to scare off a buyer, right? And so
No.
having that, even when people find sort of, someone will look at a set of financials and say, well, here's a question I have. And we find that sometimes that when the owner is like, oh, well, I didn't realize what that was, but that's not right. But let me get you the right. Like by the time we're having those conversations, the buyer's getting freaked out already.
Right.
Right. And so
That's
just
it.
that notion of even before we get to the valuation process, just getting those books cleaned up, making sure you understand things that are on there. So Jim, I don't know if we've ever talked about it, probably, but I had an accounting practice for about 17 years. I was not an accountant. I was the marketing director, but ended up buying the company. And one of the things that I find when I look at people's balance sheet, we start just going down the balance sheet. It's like, well, what's that? Well, I haven't had that truck in years. Well, we paid that loan off 17 years ago. It's like
Right.
just simply going down the balance sheet and saying, like, is there stuff on there that you don't understand or doesn't make sense? Seems to be an awfully good place to start.
Exactly. That's what I call part of the whole clean financial statements business is and something that is altogether too frequent is that owners will so-called lend or borrow money from the company. And so you see these officer receivable, officer payable, officer loan, and or deferred wages too.
Yeah.
Those kinds of things just really don't ring clean with a buyer. It makes them wonder what's going on and why. Why is the owner lending the company money? Why are they taking it out that way? That kind of
Yep.
thing. It really, like you said, can really screw up a buyer's mind.
Yeah,
It can.
that's awesome. All right, Jim, I think we're probably going to leave it there for this episode, but a couple of big takeaways that I heard were, first of all, there are different kinds of valuations, right, that depend very much on what you're trying to accomplish.
Right.
The second is that, having that clean set of books, a really good understanding of what's going on, cleaning things up, whether you're going through the valuation process or as you're getting ready for the sale process,
Right.
that's a really big deal. And that you've got a pretty impressive breadth of experience across lots of industries that you can bring to the table when people are trying to get through that path. Is that you think that captures a couple of the big things we talked about?
It does. I
Yeah.
think those are the important ones for now.
Yeah. And Kathi, any parting thoughts?
No, I found it very interesting to hear Jim talk, because going through the process myself, and then also talking to others who may not have such clean books, and really realizing what they need to do, it's really kind of solidifies it.
Yeah.
Thank you, Jim.
Yeah.
Yeah.
And one of the things that we do with Growth Team Strategies when we're working with folks, whether it's on the consulting side or the getting ready to sell side, we always talk about the need to really focus on accounting, marketing, and HR as the areas that people that are in business because of the passion they have for the business they're in. Those three areas, or some subset of those three areas, tend to be places where there's room for improvement. We maybe don't have all the experience that we'd like to have, and we can get ourselves into some trouble. So, really making sure that those resources are there. The books are good, the marketing strategy is clear, and our HR practices are solid. Kind of really help that process as well.
Sure can.
So, well, thanks, Jim, for being here. Kathi, you as well. Always fun. And, for folks that are out there thinking, even if it's a little further down the path, the kinds of things we're talking about take some time to do, right? They take some time to work through, clean up, and get better. And so we hope you'll think about that. Don't wait till the last minute. If you've already waited till the last minute, well, the best thing we can say is, what do they say? The best time to plant a tree was 20 years ago. Second best time is this afternoon, right? So get on it, right? All right. Doug Howard, Selling the Dream. We'll talk to you again soon.
Thank you for listening to the Selling the Dream podcast, starring Doug Howard and Kathi Fleck. Both Doug and Kathi have built and sold successful businesses and hope this podcast will help other small business owners do the same. Tune in every week to hear more tips for increasing the value of your company so you get the highest return for your years of hard work when it comes time to sell or transition your business. Can't wait till next week? Check out our website for more information at www.growththemes.com.